Hey guys, good evening. Welcome to you all. Welcome to another space, money space with me, Kalu Aja. Of course, on this space, we're talking money, the economy, and finance. Want to take all those topics every week, make it easy for you guys to follow, for you guys to understand. So, of course, you become a better investor, better taxpayer and the rights and all that. So, yeah, so welcome to another session with me. This week we are continuing our episode that we started last week when we talked around the financial health check. Essentially, what we're doing is trying to review your finances in 2025 and, of course, setting you up for 2026. That's what we're trying to do this week. Last week we did talk around the income and expenditures, and we talked around the entire plan for you, how you want to essentially set up your entire financial plan. Not just how to make money, but how you structure it. There's a structure to follow. You just can't save without doing certain things. So we gave you that structure. We're going to do a review of that structure again at this space. And then we're going to then go into assets and liabilities, right? Last week we did income and expenditures. This week we're going to go back and talk around just that summary of income and expenditures, and then we're going to go into assets and liabilities, guys, so you can see how we're going: income and expenses, and then assets and liabilities. So if you're on YouTube, you are able to follow, and I did share the YouTube link earlier on Twitter. So if you're on YouTube, you can follow visually. But what I want to do is just to go over the what we talked around last week, right? So I'm going to move this out of the way. What we talked around last week, how you want to set up your finances, right? And like I said, bring a notepad, because we're going to do a lot of note writing, which you can then follow up with when you get back home or look at the recording. So YouTube does the visuals, but you can just write down yourself on audio. So last week we said there are 5 stages to your financial plan. There are going to be 5 stages to your financial plan. The first is going to be, you have to plan. You have to say what you want to achieve, because everyone doesn't have a plan that is going to be similar. If you are, for instance, 50 years old, you have a different financial plan from someone that is 25-year-old. So you cannot invest as if you are the same, even though you might live in the same country and have the same currency. But you've got to invest really that you are 55 years old, you have less time to retirement, and the 25-year-old guy has more time to retirement. So your plan encompasses who you are, what's your risk profile, and how long you want to invest. That's the whole idea with your plan, right? You want to say who you are, how old am I, how long do I have to invest, what's my attitude to risk. You've got to say that in the plan, because what is determined in your plan determines the entire thing you're going to do going forward. So again, if you are older, your plan is going to be different from a younger person. You don't invest according to the instruments or according to returns. Let me say it again. You don't invest according to the returns that are available. You invest according to your plan. So very, very important. The first thing you do is to plan, and say, hey, this is what I'd like to do with my investments. You want to write down the amount. You want to be kind of specific. I would like to achieve X amount of money in my savings account by X amount of time. Then you want to put Y at the end of that plan. Very important. When you put the Y, if you can't really answer why you want to save, of course, just a wish, you just take it off, because you're just saying, I like to do this. But when you put Y, it sort of gives you, it gives a mental backing to what you want to do. So you plan out, you say, this is what I want to achieve by this time, put a monetary figure and put a Y. That's number one, plan. So again, if you're on YouTube, you can do follow and you can see what we're talking about. The second thing that you plan is you buy insurance. So what kind of insurance? Life insurance. But remember, you can't insure your life. There's nothing like life insurance. What you are insuring is the loss of income. The loss of income if you lose your life. Why? Because you have dependents, right? So if you have dependents, you want to buy life insurance that should anything happen to you, your dependents will have the means to continue to enjoy that income that you would have lost. So the next thing you want to do after you plan is to buy life insurance. So if you don't have dependents, you don't have to do it. But once you have dependents, you've got to buy life insurance. And then how do you buy life insurance? You buy life insurance to correspond to the liabilities that you have. So let's say you have a daughter you want to take to school, to Harvard, right? And you also have a mortgage, right? What you want to do is to then buy life insurance that corresponds to the how much you owe on your mortgage, for instance, or how much it will cost your daughter to go to university, right? That's going to be your sum assured, what you want to insure against. So you're going to say, hey, I want to buy life insurance for say 20 million or 50 million because if anything happens to me, I want my folks to be able to take that life insurance money and then pay for the mortgage or to pay for my daughter to go to school. So you insure that obligation. If anything happens to you, the insurance company pays you or pays to your estate or pays to your trust. Last week we mentioned a lot about trust. We said it's best to do a trust if you can. Go to a corporate trustee, do a trust account, and get a trust account to be your beneficiary. So you buy life insurance, you put the corporate trustee as a beneficiary, then you have a trust deed with the trustee to say, hey, this is basically what I am going to, this is who I want to take my funds should anything happen to me. That's what you do with insurance, right? It's not life insurance, it's loss of income to your dependents should anything happen to you. Number 3 is your emergency fund. So number 1 is plan, 2 is insurance, 3 is your emergency fund. You want to have an emergency fund of 3 to 6 months of your necessary expenses. You don't want to save or invest without having an emergency fund. An emergency fund is a fund that you set up to pay for 3 months of your expenses should anything happen to you. So what are your expenses? The necessary ones. Food, right? Those things that you must do, even if you don't have money. You don't have a fund to pay for that, right? It's going to be in cash or near cash. You don't want to save, you don't want to invest, buy Bitcoin or buy stocks with that money for your emergency fund. 3 to 6 months. If it's 15 million, of course, you're not going to have it one day, but have an account called an emergency fund and you want to save in that account, right? So number 1 is plan, 2 is insurance, 3 is emergency fund, 4 is going to be your retirement. You've got to plan for your retirement. That's the most important financial goal that you have. Because when you get older, you can't work. So it's not a question of I can work when I'm 100. No, when you get to a certain age, you can't work because you're just not going to be healthy enough to work. So you've got to plan for that retirement, right? If it's going to be your 401k or your retirement savings account or your IRA, your Roth IRA, whichever it is, you've got to have a retirement plan. If you want to buy a property and that property is going to pay you rental income as a retirement plan, fantastic, go do it. But you've got to plan for retirement before you invest. So retirement is more of a long-term investing, right? Before you buy Bitcoin, you're investing for your retirement. So let me recap. You plan, you buy insurance to pay for your dependents, you take an emergency fund, then you do your retirement. If you have worked for a company, you go to the company, you do the match. You make sure you do the match. That means the company is saying if you contribute 5%, we're going to match 5%. Make sure you're doing 5%. Don't leave money on the table. It's only after you have done 1, 2, 3, and 4 that you can consider investing. So don't rush and invest if you don't have an RSA account. Let me say it again. Don't open an investment account and start buying shares if you don't have a retirement savings account or you don't have a 401k or you don't have an IRA. That's not how you do it, because if anything happens to you, you'll be forced to sell your investments at a loss or at a price you don't want to pay for your emergency. So you've got to go through that process. 1, you plan. 2, you do insurance. 3, you do an emergency fund. 4, you do retirement. Then 5, you invest. That's what we talked around last week. And last week again, we then said how when you want to do that, let's just do a quick recap on investments, right? On the income and expenditures. We then talked about income and expenditures in detail. You want to track every single kobo. This is now your income side, what we talked about last week. Just to recap. On the income side, you want to track every single expense. You track all the expense, then you categorize it as number 2. So if you track all your expense, you say, I bought suya, I went to Mr. Biggs, then I ate at home. All that is feeding, but you can categorize it into feeding outside and feeding inside, right? Or something you ate at home. So you track the expenses and the income, you categorize, right? Then you basically want to then say, which is my active income, which is my passive income. Last week I told you guys you have to have 4 categories under income and expenditures. 4 categories. The first category is going to be your active income, which is income you make when you are actively engaged. So you go to work, that's active income. That's easy. You get your paycheck, that's active income. But there's something called passive income. Passive income is you are not at work, but you get paid. For instance, your rent. You own rent. You own a building, they pay you rent. You're not there per se, but the building is earning income for you. Or you bought a bond, and the bond is essentially giving you coupon income. Or you bought a share, it's paying you a dividend. Those are passive income. So your active and your passive are your total income, right? Active and passive. Same with expenses. There are expenses you must make, which are your necessary expenses, or what we call non-discretionary expenses. But there are also expenses that you can decide not to make. For instance, going on a holiday or just buying a new dress. The idea, your entire reason why you are working is you want to convert active income to passive income. So the point I'm making is, if you work for a company that paying you a salary, the whole idea is for you to convert your salary, active income, to passive income, which is income from your own investment. So let's say you work for company A, they pay you a salary, you buy shares, you buy bonds, you buy land, you buy property. The whole idea is you can only retire when your passive income, not passive income, can pay your expenses. That's what retirement is. When your passive income can pay your expenses. So look at Bill Gates, look at Elon Musk. They are rich because they get passive income. If they decide not to go to work tomorrow, they can still pay their expenses from their investments. So the reason, so if you can't pay your expenses from your passive income, you're not yet middle class, you're not yet rich. That's your objective. You generate enough passive income from your active income that then pays your expenses. That's the whole idea of what we're doing today. So if your passive income does not meet your expenses, it's not going to meet it in day one. That's your goal. That's your financial goal. How can I go from passive to active, right? You then want to say, okay, this year I'm going to grow my passive income by 5%. Not returns, not the volume. I want to grow my volume and returns by 5%. And that becomes a goal for you year in, year out, right? Because if you grow your passive income, that means you are able to retire. So guys, I hope you can see the plan setting up right now for us. We've talked around your 5-step plan, right? Where you have to plan, you have to buy insurance, then you have to then go and buy the retirement before you talk around investing. That's the plan you want to follow. Then when we now go to the investment side, you have to do it that way. You've got to record your income and expenses, i.e. you capture your active income, your passive income. Then you capture your expenses, the discretionary expenses and the non-discretionary expenses. Those non-discretionary expenses are the important things there, because you've got to have your passive income, the money you make when you're not there, paying your income. That's your financial goal. That's your overall financial goal. That for everyone listening to me, everybody, even me, Elon Musk, that's their goal. Make enough passive income to pay your expenses. That means you're rich. That means you can retire. So this week we're going to talk about the second side of the balance sheet, which is going to be our balance sheet, right? Where we're now bringing in assets and we're bringing in liabilities. And we also have a chart for that, for our income side, for our asset side. So the same thing, guys. For the asset side, you want to draw up a little line. There's going to be 4 characters also on our assets and liabilities. And don't worry, guys, if you have a question, just ask. Once I get through, you can request to speak. I'll just put you on queue. If you have a question, again, ask on a DM or just request for the mic, and I'll ask you to speak. I prefer you ask because I don't have to read the DMs. That sort of makes me slow down to read it. So if you want to ask a question, just request to speak. I'll queue you up. Then once I'm done, in about 5 minutes, I'll just make you a speaker, and then you can just ask your question. So for instance, on the asset side, it's going to be the same thing. We have 4 characters. 4 characters for the asset side. Number 1, you want to have what we call the income generating asset. Income generating asset. And of course, the non-income generating asset. So any asset you own today, you want to classify it as an income generating asset or as a non-income generating asset. So you have to ask yourself, is your car an income generating asset? We're not talking accounting. Accountants will say your car is an asset, end of story. We're talking financial planning. Financial planning looks at how that asset affects your cash flow. So if you have a car and you spend more money on the mechanic on that car. That car is a liability, not really an asset to you, to your cash flow. So you want to ask yourself, is that car an income generating asset or a non-income generating asset? That's how you want to classify that car. It's still going to be an asset, but is it giving you income or not giving you income? That's the classification. So you take your phone, you take your car, you take your stocks, you take your house, everything you have. For instance, you have a house in your village. You're from a tiny village called maybe Ohafia in Abia State. You have a home in Ohafia. So that home is worth, in an accounting sense, you used 50 million naira to build that home. Fantastic. That's an asset in accounting. But for us in financial planning, I want to ask you a question. Is that house generating income for you? Or is that house saving you expenses, which is the same thing? If the answer is yes, it's an income generating asset. So you put it on your income generating asset side. If it's not, it's a non-income generating asset. Just keep it aside. So it's not like it's still an asset, but it's not generating you income. Same with the liabilities. Is it an interest bearing liability or a non-interest bearing liability? It has to be one of them. So if you want to start a business and you go to the bank and the bank gives you a loan of 50 million naira, that's an interest bearing liability. You have a loan from the bank, so it's an interest bearing liability. But what if your partner gave you that money and your partner said, you don't have to pay me interest for the next 10 years? It's a liability. You still owe your partner, but you're not paying your partner interest. So it's a non-interest bearing liability. So again, if you're on YouTube, the visual is there, but if you're not on YouTube, just have those 4 columns. What we want to see is that you want to match your income generating assets with your interest bearing liabilities, which means if you borrow money, you want to only buy assets that generate an income. So if you're going to build a house in your tiny village in Ohafia, and that home is going to be a non-income or non-expense saving asset, then you don't want to borrow money from that. You want to build a house with your savings. So your savings should build you a house that is not going to generate you interest liabilities. On the flip side, if you want to build a house in a port city, you want to maybe build a warehouse in a port city, and you want to go borrow money from the bank is going to charge you interest income. That interest income should then be tied to an asset that is generating interest income. So the interest bearing liability is going to be tied to an asset generating income. So your IGA, your income generating asset, is tied to your IBL, interest bearing liabilities. The problem most people have on their financial plan is that they borrow interest bearing liabilities like a credit card, and then they use that credit card on a non-income generating activity. So if you take your credit card and you go on a holiday to Spain, right, you are generating income, interest on your credit card. So it's an interest bearing liability, but the holiday doesn't give you income. So you are mismatching your income, your interest bearing liability with something that's not going to generate any income for you. I'll give you a better example. If you have a company and you want to go buy a car, the MD wants to go buy a car to use. If the MD buys a car like a Mercedes Benz to take him to home, take him back to work, that's an interest bearing liability being used to buy an asset that does not generate income. He just bought a Mercedes Benz to go home and back. But what if he bought a delivery van? In this case, he has taken a loan, an interest bearing liability, to buy an income generating asset. So that's fantastic, because the income from the delivery van, will pay off the liability from the bank to buy the van. You want to match it that way. That's what you want to do. This is not accounting. This is your cash flow for financial planning. You are basically trying to say that any liability I have, any loan I have, has got to be tied to an income that is generating assets. That's what we're saying. I'm not asking you to go change your balance sheet for your company. Keep that. But your own personal financial health check, this is what you are doing. The same way, if you want to go on a holiday, you should have saved enough. So you are not incurring an interest-bearing liability to pay for a non-interest generating asset. You see the point? So with income, we're talking about your passive income paying for your expenses. With your balance sheet here, we are talking about that your income generating assets should pay for your interest bearing liabilities. Of course, with the balance sheet, it has to balance. So the difference between your assets and your liabilities is going to be your net worth. If you have more liabilities, then you have a negative net worth. That's what accounting would say, right? But in financial planning, it's a bit different. We understand in financial planning that when you are younger, it is okay to have a negative net worth. Why? Because when you are younger, you have no IGA, you have no income generating assets. Imagine a 25-year-old boy in Nigeria. He has no assets. He just got a job in a bank. He's earning salaries, but he has no assets. What? How is he going to buy a house, a car? How? He's going to borrow to buy that land, to buy that car. So what's he going to do? He's going to go take interest-bearing liabilities to buy his assets. If those assets are income generating or non-income generating, we don't know yet. Because he's younger with less income, he's going to borrow a lot. But when he's borrowing, he has to remember that if he's paying interest on that loan, he should divert that loan to an asset that generates income or saves expenses. Borrow to go on a summer holiday in Greece. That's not on our chart here. If he does that properly, as he gets older and starts to earn more, he then gets more assets. The assets he bought when he was younger now start to generate income for him or appreciate in value, right? So he then can use that asset to pay down his negative net worth. What we mean is, as the assets generate income, it pays off liabilities. His net worth now begins to go positive. That's the plan. That's the goal in the asset balance sheets. We want to go into negative net worth. We're allowed to go into negative net worth at the very, very beginning of our careers when we're earning very, very little. That's the only way we can buy an asset. But as we start to transit towards the end of our term in investment or working life, we can no longer borrow monies to invest because we now have a shorter compounding period. Let me say it again. The older you get, the less debt you should have because you have a shorter compounding period to pay back. So a 25-year-old guy can borrow for 30 years, issue a 30-year bond. But if you are 55, how long are you going to retire? Maybe 65, maybe 70. You have shorter times to compound your income to pay back. So it's very, very important that you start to invest early in income generating assets. And when you do them, there might not be income generating assets when you do them. That's why you have to have that long-term plan to say, hey, my long-term plan in 25 years is to retire. Where am I going to buy land today that in 25 years it will retire? That's why you come back. It's all linked. Your plan is linked to your income statement, that's linked to your balance sheet. Let me stop here because there's a lot to talk about, a whole lot. But let me pause, take a few questions, and then we'll just go on to it. Again, guys, if you have the time, try to get my book. All the stuff I'm talking about are all in my book. Planning, income, balance sheet, they're all in my book. I will try to do a screenshot of the book, balance sheet I'm talking about from my book, so we can also follow visually. But let me just take a few questions. I've got Chizobam MP. Chizobam, how are you doing? Thanks for hanging in there with me. What's going on? Chizobam, how are you doing?
I'm doing fine, sir. Thank you very much.
Yeah, go for it.
I can't get my thought. I'm on transit. When I get down, I will join.
Okay, fantastic. All right, gotcha. Let's do Integrified. Did I get that right? Integrified.
Hello, good evening.
How you doing, sir?
I'm fine, sir.
Fantastic. What's on your mind?
Okay, so I wanted to get a clarification on this, on the area of planning the future, planning for your children.
Yeah.
You earlier mentioned something in the area of life insurance.
Yeah.
But life insurance have to be something that will happen only when you are dead. And again, I think there's a kind of limit to it. So if I want to plan out the future of my children, what are the steps I can take? Or if I don't want to plan it out, I want to plan it in such a way that, okay, even if anything happens to me, that it should not be that they will just get a lump sum, which they might not be able to have much control over due to their age and the rest. How do I plan it out?
Yeah, understood. Great question. So last week we talked around life insurance, and I said life insurance is a very, very unique investment because it's the only investment you have today where you can put in £1 and you automatically have got £1 million, the sum assured. If you go to life insurance company and you say, I want to buy life insurance for 5 million, and they tell you, okay, we're going to sell life insurance for 5 million, but you've got to pay us £1,000 every month. Once you pay the first £1,000, you are worth 5 million immediately. You don't have to accumulate 5 million to be worth. Once you pay the first premium, you're worth 5 million. So it's a unique investment that you want to use to your advantage. So your question is, how can you then use that? How can you plan for your kids? I like life insurance because what you do is this. You have to go to a lawyer and write what's called a trust deed. A trust deed is just your instructions. You say, if anything happens to me, I would like my money to go towards the payment of my child's education in this school. After my child has graduated, I like the rest of the money to go to my church or to my grandmother or to my auntie and all that. You can specify your instructions in that trust deed. Now, when you do that trust deed, you then go to a corporate trustee. You have first trustees, you have ARM trustees, you have there are many of them in Nigeria. Just go to SEC and Google trust companies in Nigeria. You go to that trust company and say, I would like you to be my corporate trustee. You will pay them a fee to be a corporate trustee. You give them that trust deed. Then when you buy assets, the beneficiary of your assets will not be your children or your next of kin. It will be that corporate trustee. So look at what we've done now. If you buy insurance company, if you buy insurance policy, or you buy a building, the building is owned by your trust. The beneficiary of the trust is a corporate trustee. If anything happens to you, the corporate trustee simply then pays the education of your child or runs that company building. They'll rent out the building, collect their fees, make sure it is nice, pay the rental, pay your education, give your kids an allowance. That's when you hear trust babies, trust funds that they use offshore. It's the same thing you want complicated about it. It will cost you some money, but it gives you peace of mind. Because when you write your will can be challenged. But you can't really challenge a trust deed. You can't challenge an insurance company beneficiary. A beneficiary for an insurance company is out of your probate. It's not debatable. If you put something aside in your trust deed, it's not really going to be part of your asset because it's not owned by you anymore. If you put a building that you own in a trust deed, it's no longer owned by you. Because it's not owned by you, it can't be challenged. You see the point? And also with the new tax laws, if you earn income from an annuity, that income is not taxable. So if I want to give my daughter money, I just buy her an annuity. The annuity pays her. Annuity is like an insurance company paying you a fixed sum of money. If she's getting money from an insurance company, she's not paying tax on that income. So it's a lot of advantages for me. We're not really taking advantage of the insurance company in Nigeria. So you go sit with your insurance company and say, I heard this. Please explain to me what this guy is saying. Give me more details. How much does it cost me? They will give you specific information. Then you can run with it. Does that make sense, sir?
Yes, sir. Thank you very much.
Great. Any follow-up questions on that? You're fantastic.
No follow-up question.
I appreciate it. All right. Thank you so much. I've got Chinedu. Chinedu, hi.
Hi. Good evening, Mr. Kalu.
How you doing?
I'm doing fine, sir. I want to ask a question. I operate with this microfinance bank, and they recently told me that my loan eligibility with them is 4 million. I'm asking if I can use that as an emergency fund. I could use that as an emergency fund.
Not really, because you can't. What if you go tomorrow and tell you it's now cancelled? It's not your money yet. You have to take that loan for it to be in your possession. And when you take that loan, you are paying interest. So it can't be an emergency fund. Your emergency fund is what you have, that is cash or near cash, that you can use to cover immediate emergencies. Someone calls you today and says, hey, come to the village tomorrow, something is happening. You can't go to microfinance and say, I want to take that loan, then they give you the loan, then you pay to your account, then you have to wait for a manager to sign. No. So it's a goal for you to build 3 to 6 months out as your emergency fund. But I wouldn't say a loan is what you use as an emergency fund. No, I wouldn't say that.
Okay, sir. Thank you.
You're very welcome. Do you have an emergency fund right now?
No.
Okay.
No.
So that's going to be a key goal for, like we said, the first is plan, right? Then, of course, second is the your insurance. Do you have an insurance thing? You don't have to really answer if you don't want to. But second is you want to have an insurance scheme set up for your family. Dependents, you want to make sure you have an insurance scheme set up for them. Not for your life, but for the life obligations you have. So if you have a house, you want to make sure that you are buying insurance that can pay off the mortgage of that house. Then number 3, you want to, of course, buy your emergency fund. Get that set up. 3 to 6 months of your necessary expenses, of course, before you get to retirement. Do you have an RSA, 401k? Do you have all that?
I'm working on it yet, but
okay.
It has not been done.
Yeah. So you have a lot of goals in 2026, isn't it? You have a lot of goals, 2026. Yeah, exactly. Fantastic. So I appreciate you calling in. Yeah, get that done. It's don't wait. Don't say if I don't have money, I won't do it. Get it, start on it, early enough, and then see what happens. Yeah, appreciate you.
Thank you, sir.
All right, fantastic. Thank you, the guys on YouTube. Let me see. Yeah, so I got to slow down and read the question here. That's why I prefer the audio. Just to emphasize, could you just emphasize on the non-interest bearing? Yes, so let me just put that up again. So just to summarize the asset side we're talking about, we haven't even gotten to net worth. We are saying that on your asset side, we're not saying a car is not an asset. A car is an asset, but is that car income generating asset or a non-income generating asset? That's the question. The car is always an asset, but is that car generating income for you or not generating income for you? There's no problem if it's not. But if it's not, tag that car as a non-interest generating asset so that you match it with non-interest bearing liabilities. You have to tag it because when you do your balance sheet in accounting, they don't really care if they just do your total income. This is your total liabilities, and then they give you a net figure. But in personal finance, we want you to separate the income or the asset that are given from the assets that are not giving you income. When you do it that way, what you're going to find is that you can tell how much of your assets are being funded by liabilities. And again, like we said, there's no problem if you are in debt, as long as the debt is generating or will generate assets for you or income for you in the future. So if I borrow money today to buy a house in Lekki, no problem, because I'm in debt, so I have an interest-bearing liability, but that interest-bearing liability is tied to my income-generating asset. So for 10 years of my life, I might have a negative net worth because I have more liabilities, but that's fine. Because a liability that is funding the assets, my interest liability is funding my income asset. That's fine. As I get older, the asset appreciates in value. The value of the asset, the income from the asset now starts to pay down that loan because I no longer pay rent. So the funds I would have used to pay rent will then go to pay down the liability, so that my balance sheet or my income statement then looks better. So it's not a question of debt. Debt itself is not a problem. The problem we have with debt is that we are borrowing interest-bearing liabilities and attaching them to non-income generating assets. So this is a good place for us to segue into debt management. Every time we talk around assets and liabilities, the main problem with assets is how to accumulate them. and we can talk. We're going to have a separate space on how to accumulate assets. Which assets should you buy? We're going to do more of assets allocation. What should you buy if you have a goal today of retiring in 5 years? What should you buy than if you have a goal to retire in 15 years? That's going to be asset allocation. We'll talk around that. But what about debt management? How can you manage your debt? Because now, if you have built up a balance sheet that has more interest-bearing liabilities than your assets, your income-bearing assets, you're going to have a problem. So what should you do if your balance sheet is more in debt? Of course, you've got to reduce those debts, right? You've got to bring down those debts. So how can you manage your debt? So let me just give you a way you do it, the way you're supposed to do it. Let me just real quick, Kinijo, you want to ask a question real quick, and I'll talk around debt management, Kinijo? I know the network is kind of unstable. Kinijo?
Yes. Hi, Carlo.
Yeah, I'm not sure I can hear you too well. I got a bit of audio, but try, let's see.
How about now?
What's the question? Is
Okay, so I was trying to find out about something we've been debating in my household. So it's getting another property, right? Or paying off the debt of the current one we have.
yeah.
So are you going to classify paying down your debt as, a financially brilliant move, or getting another one so that I can have someone rent that and, have that passive income?
Yeah, I hear you. Good, great question. It's got to go back to really what are the numbers saying? If you can get a tenant that can pay your mortgage, it's always a good idea. Because now you have the asset, but you have no liability. In which case, if you go back to our table, it's like saying you want to get a new income generating asset without the corresponding liability, because the liability is now going to be taken over by the tenant. So if I understand your question, you already have one interest-bearing liability, which is your home. Are you guys living in that home? The one you're paying? Do you guys pay a mortgage on your current home right now?
Yes, we pay mortgage on the current home.
So it has cancelled out your interest-bearing liability with your mortgage is being cancelled out with your income, right? This new home you want to get, the simple question for you is that, can you get a tenant that can pay the liability? That's what you want to ask yourself. If you can get a tenant to pay that liability, fantastic, because you've without a new liability.
Yes, we can get a tenant, but the question will be the duration when you don't have a tenant. You'll be liable to take care of two mortgages.
Which is the answer, which is exactly the answer I say. If you can create an asset without creating a liability, the answer is always yes, which is not the problem you now have, because your problem is that you are unable to create that asset without creating a liability. You've got to make sure if you don't do it this way, you're going to lose that house because you can't pay the liability, so you lose that asset. You see what I'm saying? The answer really it comes down to if you can get a tenant that can cover that liability, or if it goes south, you guys have got to have an emergency fund of at least 6 months of that tenant, that mortgage. You've got to have it in a bank sitting somewhere. So say if anything goes wrong, we can pay 6 months of this house mortgage without waiting for a tenant. If you guys have that sort of savings, it might be a good idea. Because again, remember in the West, are we talking about the West? Are we talking about Nigeria? What are we talking about now?
We're talking about the West.
So, of course, in the West, they do non-recourse loans, right? So, which means you can walk away from the property if you can't keep it anymore. So, if it's a non-recourse loan, you don't have any liability you don't have any contingent liability. They might come after your building, right? So, what I would say, think about setting up an LLC to buy the property, right? Set up an LLC to buy the property. Then get a tenant to pay rent to the LLC. So that way it's an arm's length transaction. If the tenancy fails, walk away, close the company, declare bankruptcy on the company, move on. So the bank takes the building, you start afresh.
Okay.
That might be risk management for you. Yeah.
Okay, thanks.
Fantastic, man. I know someone joined. I don't know who it is. I know someone just joined. I'm not sure if it's Jibril Dev. I'm not sure. Did you just join?
Yes, I just joined. I don't know if you can hear me.
Yes, I can hear you. Go ahead.
Okay. Please ask him whether I can get the copy of your book, or please where can I get it? I mean, Kano State. I don't know about the book. And you said that you shared a screenshot of the book, so I'm wondering
Yeah.
about it.
I'm sorry. I'm in a hotel. I'm in transit, so the network is really really slow. I'm not able to download the book and share. Just I'm on YouTube. It's just struggling. So what we're gonna do, right? Send me a DM. First of all, the book can be gotten on Amazon. It used to be the local bookstore in Nigeria, but we've printed three editions. It's all sold out. It's sold out. So it's easier on Amazon because it's just easier on Amazon. The prices have gone up and all that. So if you go to Amazon, it's Christmas, people are coming home. Just I don't get it for you. The price is unchanged in dollar terms. It's a good present for you. They can get it for you and just deliver it to you on Amazon. For the other screenshot, I wish you can. If you send me a DM, right? Just send me a DM. I will try to send you a screenshot of what we're talking about. I do. I'm on. The network here is really, really slow, so I'm able to do all that stuff. Yeah. Does that work for you, Jibril? I'm not here if you can hear me. Jibril, do you hear me?
Yes, sir, I can hear you. I have already sent you the DM.
All right. I will try to once I get to a place that's got like fantastic internet. I will try to just send you a few screenshots. But Amazon is just going to be the best place for you to get that. Right. Fantastic. Thanks for hopping. I appreciate it.
Okay.
All right.
Thank you.
Yeah. So I was talking around debt management before we took the call. Debt management. This is a big issue. We've done a lot of space on debt management. My book has a chapter specific on debt management. So how do you manage debt? And what is this debt we're talking about? If you go back to our financial plan, debt is when you have accumulated interest-bearing liabilities and you have no income-generating assets to cover. Remember, debt is not the problem. The problem is that you have generated that income liability with no interest assets. That's what the problem is. So let's say you have a debt problem. How do you get out of it? So number one, make sure you write this down, guys. Number one, you want to list out every loan that you have. Every loan. Just list everything out. What I mean every loan, I mean every loan. Your brother gave you money, that's the loan. Write it down. The bank gave you a credit card, that's the loan. Write it down. You borrowed money from your cooperative. List every single loan down that you have. That's number one. Number two, you want to then attach a cost to the loan. So let's go back. Your brother gave you money, he's not charging you interest, so you put 0%. The bank gave you a credit card, they are charging you interest 25%, you put 25%. Your cooperative gave you a loan, but it's a subsidized rate, it's 5%, you put 5%. So now you have your brother 0%, you have your bank 25%, you have your cooperative 5%. So number one, you listed all your loans down. Number two, you attach the cost to it. Number three, you then attach the cost, after you wrote them. Number four, there are two ways to do it. There are two ways to do this. There's what we call the avalanche. There's what we call the snowball. And forgive me, I'm not sure which is which. I mix them up a lot. There's the avalanche method and there's the snowball method. With the avalanche, and again, forgive me, I hope I'm not wrong. With the avalanche method, what you are trying to do is to pay the loan with the lowest amount first. It could be the other way, again, forgive me. So let's say you've listed your loans out. Remember, you have your loan from your brother. Maybe he's charging you 0%. The loan from the credit card is charging you 25%. The loan from your cooperative is charging you 5%. You list the loans out in order of the APR, i.e. the cost of the loan. You pay the loan, the one method says pay the loan off that has the lowest amount. So let's say you owe your brother 5,000, then you owe the bank 10,000, then you owe the cooperative 25,000. It says you pay your brother first, the 5,000. Why? You want a quick win. When you pay your brother 5,000, you take that same money you used to pay your brother, and you can start to pay the other guy off. You pay the bank off. So you pay the loan, the dollar amount that is lower first. You pay that off, then you instantly transit to paying the second loan. Then you then go finally to pay the third loan. So you pay in terms of the lowest amount first, because you want to start to get rid of them, have quick wins, and you don't stop. When you pay that lower amount off, you simply take the money and you go back to pay the next one. So you have a plan to say, I'm going to pay this off, and instantly move to the second one, and move to the third one. That's one method. The other method is you pay the loans that have the highest cost off first. So let's say your credit card, you are owing $50, but you are owing your cooperative $50,000, but your credit card is charging you 25%. Your cooperative is charging you 5%. This method says you pay the credit card off first, because it's a higher APR, higher interest rate. So it costs you more to keep that loan open. So you pay that credit card off first before you go pay the cooperative, which is at 5%, before you pay your brother, which is at 0%. Why? Because it costs you more. This is the preferred method. Pay the loan that costs you more than to pay the loan that have the lower amount. The problem is that the lower amount gives you a quick win, so you can see instant gratification. It's good, there's nothing wrong with it. But to pay off the loan that has the higher APR is going to give you your balance sheet a bigger boost. So number one, write out the loans. Number two, you attach a cost to the loan. Number three, you rank them either by amount or by the cost. Then you just start to pay them down. You basically just say, I'm going to go back to my budget. I'll cut out an expense from my budget that I don't need. I'll cut out a non-discretionary expense that I don't need. Or I mean a discretionary expense. Maybe I'm buying it. Maybe I watch DSTV. I'll cut out DSTV. Use that DSTV money to pay the principal. Remember, guys, the trick is to pay the principal. If you owe credit cards and you simply pay the minimum on your credit card, you're not going to go anywhere. It's going to cost you years to pay that credit card off. You've got to pay the principal. If you own a car, the bank will tell you pay us on the 15th or on the 25th an payment. When you make that payment, the bank will take some money to the principal and some to the interest. All financial institutions will first of all take their interest first before they pay the principal. So that means when you pay a bank, you are paying more to interest at the early loan than you are paying to the principal. So how do you counter this? Pay 2 times. If you pay the bank their own, go back and say, I'd like to make a payment. I want to make principal only. Tell them principal only. That money you're paying goes to the principal. It doesn't change your monthly payment, but it reduces the loan tenure from, say, 5 years to 4.5 years, which is all you need, right? You want to reduce the tenure. So when you have a fixed loan and you make a principal payment, you are reducing the term. But on a credit card, when you make a payment to the principal of the credit card, you are actually killing off the loan on that credit card, because you are killing off what the credit card is charging you every month. The credit card looks at what you owe. It will calculate your APR every month and charge you a very, very expensive rate. So when you make your credit card payments, try to make it twice. You pay the bank, then you pay again, and you tell the bank, no, the credit card is automatic. Once you pay, it goes to principal. But with the other fixed loans, you've got to tell them principal only. So you go to the principal and you can pay off the loan. So that's how you want to do a debt management, right? You identify and you pay off with a plan and with a purpose. Don't leave it to chance. Don't say, I'm not going to pay this loan when they call. Have that plan. It's very simple and it will work for you, right? So with this, we're talking income. So we're talking assets and liabilities. We're focusing now on the liabilities side, which is your debt, how to pay off that debt, yeah? So now when we want to do asset, we're going to have a whole new space, because that's a whole new topic. We're talking about asset allocation. I want to do asset allocation in a separate space with you guys, because that's very, very important. How to invest. So many of us are investing wrongly. We are investing according to returns, not objectives. You don't invest because it pays you more. You invest because your objective is this or that. For instance, if your rent is due next year, there are certain investments you cannot invest in with the excess money you have for your rent. You can't buy crypto with your rent money. You can't buy stocks with your rent money. It doesn't mean crypto and stocks are bad. It simply means that your duration is too short for you to make any compounding return with, because it's just 1 year, and stocks do better over an extended period of time, not 1 year. So there is no better investment. Stocks are not better than fixed income, but those stocks are going to be attached to your objective. So many times people say there's a federal government bond, and the federal government bond pays lower than inflation. People say, oh, it's paying lower than inflation, I'm not going to buy it. That's not how you look at it. If you are a retiree, unfortunately, that's the only thing you can buy. You can buy property, you can buy fixed income, but you can't go buy crypto as a retiree. Also with stocks, you have to be very careful with buying stocks as a retiree, because you have no compounding period to recover from should those stocks fall. Last week, the market, crypto has gone from 126, it's now about 85. Imagine if you bought crypto in your retirement account, how would you have recovered? It doesn't mean crypto is bad, but crypto is for younger people that can afford to sit on a loss for a longer period. Because when your crypto goes from 125 to 85, the worst thing you can do is to sell. You don't want to sell. You want to stay in the market till it recovers. But if you are not selling and you are 85 years old or 75 years old, how do you eat? You have to sell to eat. So you're going to sell that crypto at a loss. That's the point. You invest according to your objectives, not the returns that are being offered. Keep that in mind, guys. Don't ever invest because the returns are high. You want to ask yourself, what type of investment is this? If it's a long-term investment and you have a retirement plan, of course you invest. But if it's your rent money, you have rent money today, but it's due next year, you don't buy crypto with your rent money. You don't buy stock with your rent money, because it's not guaranteed. There is fixed income, which is guaranteed. There's variable income, which is not guaranteed. Variable income always has a better return than fixed income because of the risk factor inherent in it. All right, folks, let me just read a few messages here so that I can just get the party going. Yes, I'm investing in my yes, so that's exactly what I'm saying. You said I should not invest in, I should not buy investments unless I have a retirement savings account. Please, can you explain more on this? Because I'm investing and that's my retirement. No, look what I'm saying. If you are investing, it's always a good idea. It's always a good idea to invest, whether it's in your retirement savings account or in an investment fund. But when you put money in America, it's called the 401k or the individual retirement account, IRA. In Nigeria, we call it the retirement savings account. Those accounts are what we call tax advantaged accounts, which means any funds you put in that account, you don't pay taxes. Not only do you not pay taxes, those accounts grow tax deferred. What that means is that when you put money in that account, it will compound without you paying taxes. So you are able to then grow that portfolio faster than an account where you are paying withholding taxes and the rest. So long term, having money in the retirement savings account that is tax deferred has a huge advantage because you're not paying taxes. So the first place you want to invest is not your own personal investment, but in the retirement savings account that the company is offering you because it has a tax advantage. So if you live in America and the company offers you a 401k, they will tell you if you contribute $1, if you contribute $1, we'll contribute 50 cents or 10 cents or 1 cent. You want to take advantage of that because that's a salary increase to you. Same in Nigeria, if you contribute 8%, your company will pay 10%. 8% of your basic housing and transport, your company will contribute 10%. So why would you not first of all maximize your retirement savings account and get the 10% from your company before opening up your own? You can open up yours after you have done the company's retirement account. You don't do yours and not do the company retirement savings account. You have to do the savings account from the company that is tax deferred first. Max it out, then you can go do yours. It's very important. And if you're in America, the best investment you can have is called a health savings account. With a health savings account, when you put money in, it's tax exempt. So you put money in, you can write what you put in from your income. So you take that off your income. When it grows, it's tax free. So you put money in, you don't pay taxes. The money grows, you don't pay taxes. When you take the money out, you also don't pay taxes. So look at it this way: you are 25 years old, you are very, very healthy. You open up a health savings account. Every month, put $25 into that health savings account. Every month, it's going to grow tax-free for every year that you are working. Every year, you just put it in. When you retire, all that money you have built up, you can withdraw that money for health-related expenses tax-free. You can buy shoes, sneakers, you can buy drugs, you can fly to get a massage on a Greek island, which is healthy. You can go and get a mud bath in Turkey. Those are all health-related transactions. You can buy vitamins and not pay taxes when you take it out. There's no other investment that gives you a 3 tax benefit. When you put it in, grows, and take it out, is tax deferred. So if you're in America and you're listening, you want to make sure you go open up a health savings account. Ask your employer. Most employers will offer that to you with a high deductible plan. Ask them if it's a health savings account. Make sure it fits your objectives and you want to go get it. So that's that for that. Integram, you have a question? Please go ahead. Integrified. Go ahead, your question. I'm just going to read this.
Okay. Thank you very much. So my question is, for example, you have your emergency fund, you have I'm in Nigeria, though. You have your emergency fund, you have your what do you call it, your health insurance, you have some other things, but you want to actually invest your money. I have tried working around this. How am I going to aggregate my investments? Okay, like 5% goes to stock, 2% goes to real estate, 3% because currently I have high affinity for risk because of my age. But I do get a little bit compared. Recently, I saw that, okay, I've been just throwing money around, and at the end of the day, you see that you have many things, but you have nothing because none of them can actually give you a good leverage. And I wanted to get an understanding, like to get maybe guidance on how I can aggregate this. And also, I don't know whether it should be possible to maybe discuss with you later on, financial mentorship.
Okay. Yeah, so the question you're asking has to do with what we call the asset allocation. That's what we're going to do on our next space. Essentially, what you talk about with asset allocation, you say, this is who I am, and I want to invest money. What should I buy? And that's where most people feel it. So when you do your asset allocation, the way you do it is essentially going to be, it's about 95% of the success of your plan comes from your asset allocation, about 95%. Or 95%. So if you get that right, and I'll use an example. How old are you? How old are you? Like below 40, below 30, below 50?
Okay, I'm 32 years now.
Okay, so if you're 32 years old, right, just on the age alone, that tells me you have about, let's say you want to retire when you're 65. That's how many compounding periods you have. You have a very, very long compounding period. That means you can afford to invest. When do you think, if you invest, you want to take money out? When do you think you're going to retire?
Actually, I want to stop working for somebody within maybe in the next 5 years, and I want to stop working for money, maybe maximum within 45 years.
Okay, so I like that plan. So if you have 45 years and you are 35 years today, what you are telling me, what I hear you say in financial terms, that you want to build up your passive income in 10 years. That's what I hear you saying.
Yes, sir.
Okay, so look at the math here, right? If you want to get, let's assume interest rates at 10%, just to make it easy for us. Let's assume interest rates at 10%, right? Let's say the answer. Let's say what do you earn right now? Do you earn below 1 million, below 2 million, below 3 million, below 4 million, below? What do you earn? You earn. Give me like a range. What do you earn?
I earn between 2 and 3.
Okay, let's just say you earn even 5, just to make it to math easier, right? So let's say you earn 5 million, right? So what you're saying is that you want to earn, so half of 5 is 2.5, right? Is that what you want to earn 2.5 million? Let's assume there's no inflation. You want to earn 2.5 million in 10 years. Let's do the math. So 2.5% is the end figure. Let's say return on asset is 10%. What should I put in front of 2.5 million? That if I multiply it by 10%, I'll get 2.5 million. What's that first figure? It's very easy maths. So what should I put that if I multiply by 10%, I'll get 2.5%? What's that first figure? How much would that be?
Okay. That would be 25.
Excellent. 25 million, excellent. So what you are saying is that you want to go from 3 million active income to 25 million in savings that will generate you passive income of 2.5 million every year in 10 years. That's what you're saying. You're going to go from your current income today. If you sent me about 3 million, I moved it up to 5 million. So right now you earn income today for you is 5. What your plan is that you want in the next 10 years, and when we say 10 years, we're taking to periods. So 10 times 12, you are saying you want to have in 120 compounding periods, you want to make 25 million. That's what you want to have in 120 compounding periods. At 120 compounding periods, you want to have 25 million. That if inflation is 10%, it will generate 2.5%. What do you think in Nigeria can give you 10% today? What do you think?
What can give? The only thing I was made that I'm very sure can give you 10% is something like TE, but
it's something like what? Something like what?
Like TE, like TE Vest, or some other savings, or maybe business actually. But or maybe one.
Yeah, so
TE Vest is like 12% now.
Okay, so fantastic. I like how you say. So you're basically now you see you're looking for the investment that can give you 10% that you want to invest. I will give you 25 million in 10 years. That's what you're doing, right?
Yeah, but the 25 million I think is the annual earning. Actually, for example, earning 2.5, let me say 5 years time annually will be very low because
that was your plan. That was your plan. I just gave you your plan out in numbers. So now you see how your plan starts to fall apart because you yourself are now agreeing that 2.5 is not going to be a lot. You see the point when you put it on paper. When you want to say you want to stop working for someone in 10 years. That's what you said. So if we went back and we put those numbers and figures for you, you can now see where your plan is. That means you need 125 million. If you want to have passive income, if you want to retire, you want to have passive income that can cover your expenses. So what you want to do today is to say, what are those expenses that I have? Then number 2, what is my passive income? Today, your passive income cannot cover your expenses. Your active income can. So you said in 10 years, you have 120 compounding periods to start to convert huge amount of your active income to passive income. That in 10 years, you want to pay at least X amount of your income from passive income. It's possible, it's not possible. The fastest way to get to that number, sir, is to start a business, not to invest. If you start a business today, then that becomes active income, but it generates you more income to invest in passive assets. You hear what I'm saying? If you work for your, if you start a business, you generate more active income. That active income allows you to then buy the passive assets that can generate you 50% of your expenses. Remember that as you get older, your expenses are going to go up. Maybe today you go to holiday in Ghana. In 10 years' time, I want to go to holiday in Greece. So your expenses are going to go up. So it's a tall order for you. That's why this financial plan is a very, very delicate topic. You've got to have your plan on paper. When you put numbers and you then see it doesn't make any sense. Either I'm in the wrong job, or I need to change my country, or change my my assets. So or change the currency I'm earning in. Because if you do it that way, then it makes sense. If you were in America and you want to retire in Nigeria, your whole calculation changes, because now you are bringing dollars back to Nigeria that, if you convert, can give you sufficient income to live out your passive income life. Do you see what I'm saying?
Oh, yes, sir.
So investing is about looking at all those and what should we say, options, and then basically saying this is what I would like to do, and then using those options to then do your financial plan. Because it's not like you said, it's easy to say I'd like to retire in 10 years, but when you look at the figures, it's very, very daunting. But the principles don't change. It's how you want to achieve those principles that change. Yeah? All right, thanks, Instagram. I really enjoyed using you as an example. Really, really do. Yeah. Regarding me, to me, honestly, sir, it's best to just send me, just also ask me a question on the timeline and I'll respond. Yeah, I get a lot of requests. Sometimes I don't go there. Just ask this question on the timeline and I'll respond. Yeah. Tag me, ask me a question, I'll respond. So, question from YouTube: how easy is it to get the money from the RSA once retirement reaches, and can the RSA balance be added to the trust as an asset? Yes, it's rather easy to get your money from your retirement savings account. They give you what you need to bring in, documents you need to bring in. Once you're about to retire, tell them, they'll tell you what to bring in. You bring it into the company, they will pay you. I believe they pay half of your money as bulk sum in cash, and they pay the rest as an annuity to you. Yes, you can put a trustee as your beneficiary, so that trustee can receive those pension assets. I see where you're going with that. Yes, you can do that. Most people are not using the RSAs the right way, right? You have a guaranteed stream of income that's going to come to you when you retire. When you have your financial plan, do you take that into consideration? When you want to go buy that mortgage, you want to tell the mortgage company, I have this guaranteed stream of income coming to me in the next 25 years. Can you give me a house today, and I will look for a way. I'm not going to tell you what to do to attach that stream of income to pay down that mortgage. Your retirement savings account is your long-term savings. It's going to guarantee you a stream of income, guaranteed by the federal government. Not taxable. It can't be stolen. It's in your biometric name. It's in your name, not of the company. It's in your name. That's a huge asset that you want to take advantage of. Very, very few Nigerians are in that scheme. Less than 10% of Nigerian workers on Nigerian labor force is in that scheme. So they hit a wall of about 10 to 15 million registered Nigerians. But they have the informal sector. That's where you have to go after. Many informal folks do not earn a salary and do not save. So you have to make sure that you are saving in your retirement savings account. You don't have to go to a PFA. They have micro PFA now that can enroll you as a small business, and you can enroll in those corporations. Start to save, because it's a compounded return. You get professional management into those accounts, and it might be the only savings that are available for you that is separate from your business. Your business cannot be your retirement scheme. Your business cannot be your retirement scheme. That's just your business. You've got to separate your business from your income. Your business pays you an income. Your business is not your income. Separate it. So if you own a business, the income should come to you. So that way you can transit the business to somebody else and still get the income. Shares, when you incorporate equity, you hold equity. The equity is owned by yourself, and the business then pays dividends to the equity which you then own. You don't have to work 24/7 because you own a business. You can own the business, get the income, and not work 24/7. That's why passive income is the goal, not active income. Passive income. All right, I had this gentleman here. He's dropped. Hamid, how you doing? Hamid, hi. Hamid, go ahead. I can hear you, Hamid. Let me go back to DM. Yeah. So yes, the most of the questions that get repetitive, but yes, we're stressing. Hamid, let me just put Hamid, when you're ready to speak, just I'm going to mute you. When was Hamid just unmute and then we can speak. Jeez, lots of folks want to speak here. Yeah, okay, just yes, we're really focusing on the topic of passive income. You've got to understand that that's the whole goal. If you are rich, that's because of passive income. We're not telling you here go and buy X or Y. This is the structure that you want to follow. You can't say you want to retire. We just had a conversation with Instagram, and I just walked you through how this is done in real life. If you go to a financial planner and you say, I'd like to retire, they're going to ask you, when do you want to retire? What they want to get from you is your compounding period. They'll ask you, okay, what is your goal when you retire? Are you just going to go to an island and live on that island? What they want to get from you is also your expenses when you retire. Then where are you going to retire? Are you going to retire in the United States, or are you going to retire in Nigeria? Why is that question important? The inflation. If you retire in the United States, it's easier to plan because inflation there is really easy to plan and organize around. In Nigeria, we've gone from 40% inflation 2 years ago, or about, if you say effective inflation, about 10% inflation, to now we are being told the inflation is 16% in less than a year. So who do you believe? If you go from 30% to 16% in less than 2 years, it simply tells you it can go back right up. And again, why is the interest rate still high if the inflation rate has come low? But if you are in Nigeria, the planning is a bit more difficult because we don't know where inflation is going to be in the next year. So you've got to save more if you're in Nigeria. But save what? You can't save in Naira, because the Naira is a very, very unstable store of revenue or stuff of assets. If you hold the Naira today, you are losing officially 16%. Just holding Naira in your hand, you've lost 16%, which is the inflation rate. If you hold a dollar in your hand, you've lost 2 to 3%, which is the inflation rate. So which one do you want to basically hold? It depends on where you want to retire and where your expenses are going to be. The best investment scheme or retirement scheme I have seen is a guy that works or earns in dollars that wants to retire in Nigeria. That's perfect because you're getting a dollar, you're bringing it to Nigeria to spend. The dollar is stable, Naira is unstable. You can afford all your expenses in Nigeria, but not everyone is in that class. But then again, if that's where you are today, you want to start to then broaden your investment horizon and saying, I want to buy more dollar investment. Not because Naira is bad, but because you want to get access to a currency that is more stable. Inflation is the problem. If there was no inflation, we wouldn't be having this Zoom class. Because all we do is when we earn money, we take 10% of our money, dig the ground, put it in the ground, cover it, and then we're good. It's because of inflation that we're worried about talking. Because if you save today and it doesn't beat inflation, you're wasting your time, right? But we have to still save, right? We still have to save. Fantastic, guys. Let me go back to DMs. Yes, we've spoken about inflation, we've spoken about passive income. Yemi, we've talked a lot about that. So if you just go back, it's basically going to be recorded. It's on YouTube. It's also on the podcast. If my podcast is the way I see it, it's also on my DM there. You can get the podcast to be recorded and to be released. We have about 15 more minutes, and we're going to call it off. Because just because I'm in transit, so I'm really getting good download speeds. I want to share a lot of stuff. I cannot do it, so we'll have to call this early, and then we'll call the day. And then next week we should be able to then do more of the investments. We've started off from income and expenses, and then we've now moved to assets and liabilities. We've talked a little bit today about debt. I said that with debt you want to do your categorization and pay off either according to your to the highest debt amount or the highest debt percentage. I prefer you pay the higher APR because that will take off your what's it called? It will make it easier for you to pay. Pay to the principal only. It works in your favor, right? And then next week we're going to do more of asset allocation because we need a lot of visuals for that. So I'm going to make sure I have my visuals up, and then we can share that together because that would show you guys essentially how to invest. Many of us are investing for returns. That's a bit not the way you do it. You want to invest for your objectives, and if you're younger, you invest different from if you are older, right? I'm waiting for Emir. Lots of guys want to speak, but I cannot add them. Emir is still floating. Emir, can you hear me? I can see you struggling to log in there. Yeah, you see, I add you guys, but it's not going. I think it's just a network. Let me get Ola. I'm going to add Ola also. And Emir, I also sent you that request. I think it was a network. Let's see what happens, yeah? Ola, how you doing? Ola Otun.
Okay, boss. How you doing?
I'm doing very well, sir. I did fine.
I already bought your book.
Oh, nice.
I'm lazy. I have to read your book, sir.
Okay, I'm doing an audio version very soon for the day. Like I'm lazy too. I just do audio books.
No. So you are our boss. You have been a leader. God bless you, and I'm praying for you.
Thank you,
God
sir.
continue to direct your path.
I appreciate that.
Sir, I live in Abuja, and I missed last Sunday, about 2 Sundays. I don't know if there's any way you can do. So for me, I'm more of listening and reading. So you have said a lot of things, and honestly, I wish there's a way you can do like a transcript or something that's audio that you can even sell on Google. You can make money, sir. You can really make a lot of money. I live in Nigeria, so I'm a Nigeria person, but my family, they live in America. So if you can help, for me, I want to do a lot of investments in Nigeria in terms of life insurance and all of those things.
Yeah.
If you can set up things that because I see that you talk around APR and American financial system, but Nigeria, coming up with this our law that's taken up in January.
Yeah.
I think we'll begin to transit to global space. But my point is to say that your book, you said, someone should go and read a page. I missed that one. I was jumping between my room and the kitchen.
Okay.
So if you can do something that will help us in Nigeria to now begin to do, now that we're transiting into a more like UK tax system, things that can help us and the companies. But please do not advertise for any companies, sir. And I appreciate that. Thank you, sir.
Yeah, we've done a lot. So you said a lot. So the last space is recorded. So if you go to I think that we do a podcast recording, and I made sure I did the YouTube recording as well, just to have the visuals in. So both are recorded. I think I have a channel on YouTube. Try to find me. Also on the podcast handle, you can see the recording there. Make sure I post everything up so you can see there. It's I'm trying to bring the language very, very, so people can follow. But like you said, there was a page I put up last week, and it was there. It summarized everything. This is also being recorded as well. As regards to the book, I wrote the book with Nigerian language and Nigerian parlance. I try to use as many Nigerian examples. So the investments I talk about there are Nigerian stock market, investment funds. There's a whole page in on my book around funds, where I picked a particular fund and I'll say this is the fund for this. I'll say if you want to get long-term investing, use this fund. If you want to beat inflation, use this fund. If you want to do gold, use this fund. Nigerian funds, not US funds. So even when we do the budget, we talk about generator. There's no generator in America. There's no generator expense in America. That's why I always talk around the book. It's all my experience, Nigeria, the US, managing money for rich people, for pension funds, for trusts. I even did an Islamic fund at the time in my life. All that I wrote in the book and I put it there. It's very, very rich. So you want to get the book and keep it, right? And there's going to be an audio book coming very soon. So you can listen. People like Ola can just listen. If you're driving home, just listen to it. It's very, very rich. Ola, go ahead.
Ogakalu, you are an amazing boss. You are teaching a lot of people how people have resources and they don't know how to turn it around. God bless you. And I just wish you keep helping us. God bless you, sir.
Thank you. I'm trying. So the one thing I see in Nigeria, and I'm not calling anyone out, if you make something free, people don't really value it. So I always tell people, like, my day job, this is what I do in my day job. People come to me and say, I want to do this. And I tell them, this is how you do it. And then they pay me. Or they pay the company that I work with and all that. So this is my pro bono, especially to Nigerians. So if you notice my page, I talk a lot to Nigerians, and I try, if it's possible, not to charge. I could do a master class. If I did a master class on this exact same space, I would have double the number of people on the space, and they will all be paying. So I'm not saying people just have to understand that money thing is not like if you have a pain in your tooth, you're going to pay a dentist to take it out. If your car is bad, you're going to call a mechanic to take it out. But people with money, there's this sense that it's my money and I can manage it. That's kind of wrong. Money has a certain way it has to be managed. There are certain principles you've got to follow. If you get it wrong, it's it's costly. If you lose money, you have to make more money to compensate for the inflation and for the time a lot. I'm not telling you to go buy this stock or that stock. I'm giving you how you want to arrange your financial life, right? Plan, insurance, retirement before you invest. If you don't do this stuff this way, it's going to cause you problems down the line. So this is the point I'm making. Universal principles. It's not a Nigerian principle. The universal principle. If you do your financial health check, like I said, this is New Year coming. We have a New Year coming. You track your expenses, you track your income, you categorize both of them. You know what is passive, you know what is active, you know what is non-discretionary expenses, you know what is discretionary expenses. Then you then ask yourself, this year, 2025, how much of my passive income can pay my expenses? The answer might be 1%. Maybe you have expenses of ₦1,000,000 and you only have passive income of 10,000 naira. So today, your passive income can pay 1% of your total expenses. Okay, what will be your goal in 2026? Can I move that 1% to 5%? You see how simple this is? Simply move that 1% to 5%. I say in 2026, by December 2026, I would like 5% of my passive income to pay for my expenses. That's a great goal for you. That means you're going to have to go back in and, number one, increase your investments, and number two, reduce your expenses. That's a goal that everyone can agree with. Then 2027, can you make it 6%? If you keep on doing this way in 20 years, you'll find that by in 20 years' time, 25%, 30% of your passive income is able to pay for your expenses, and that's the entire goal of retirement. You can't say you want to retire. Retirement is when your passive income can pay your expenses. That point where your passive income graph, which is up, down, can pay your expenses, which is like a straight line, it goes like that. That's when you can retire, guys. So I appreciate you guys hopping in here. Like I said, the network really is not allowing me to share really a lot of stuff I like to share. So we're going to end a bit earlier than we would have normally ended. Normally we're here for 3 hours. Let's see how long we can. Just next time we do meet, I should be able to have all these visuals and we should be able to get it across to you guys. So pardon me, guys. We're gonna just try to shut it down. A lot of DMs, I hear you, but might not be able to get a lot of them in. Let me go to YouTube. Yeah, we're talking about RSA, protect the book. Get the book on Amazon. It used to be in a Nigerian bookstore, but I think now it's gonna be Amazon for now, guys. What else? Let me just look a quick look at DMs and see if there's anything that is interesting. I like this one. I have a house in Lagos. I have a house in Lagos, but my family is living in the house in Lagos. I have a second house, so he has two houses in Lagos. His family is living in one house. Would I classify that house as an income-bearing asset or a non-income bearing asset? You've already answered the question. Is your family paying income? If your family is not paying income, again, like I said, we're not talking the accounting definition here. There's a reason why we're making it income assets and non-income assets. If your family is living in that house, I don't think they're paying you income, right? The question for you is, are you paying interest liability on that home? That's the question for you. That's the question for you. If you've got that home and there's no mortgage and all that, fantastic. It's an asset for you and there is no liability on the other side. So it's fantastic for you. But it will not make sense on a financial planning basis for you to go borrow money and have a home and then give it out to family members that do not pay you any rent. Because what you've done, that you've created an asset and incurred an interest-bearing liability, but you've not created a corresponding income-generating asset. So your net worth is not just negative. There is no opportunity for that net worth to become positive. I hear you. Don't confuse income and value. I hear what you're saying, that the house value will rise. That's not what we're worried about here. You can't go to a restaurant and tell the server, my house is worth 1 million. Give me a plate of rice. No. You've got to pay for the plate of rice. So the house has got to generate income. That is income. The value of the house is the asset. Remember, we are comparing income generating asset. It's still an asset to interest bearing liability. It's still a liabiliity. We're not saying that the income from the house makes it not to be an asset. No, it's still an asset. But what sort of asset is it? Is it giving you income or is not? Following your example, I'm following you, sir. Following your example, the house is not giving you income, but you've got a loan to buy a house that is not giving you income. So your net worth is going to not only be negative, but you're not giving your net worth any opportunity to generate income to pay off the liability. There are two things there. The net worth itself is asset less liabilities, but below that, that asset is supposed to generate income that goes to your income statement that should pay off the liability. On this asset base, we're not worried about the income or the liabilities on our balance sheet. Let me just put it up. We're not worried about the income on the balance sheet. What we are asking is that asset itself generating income? We're not asking to put the income on the balance sheet, but we're asking, is that asset generating income? If it's yes, fine. If it's no, fine. Match them. If you have an overload of interest-bearing liabilities, your net worth, our issue here is net worth, not liquidity. Our issue here is net worth. Then you would have a negative net worth. And not just negative net worth, on your income side, you have no income to service this interest-bearing liability. So you're going to be asset-rich and cash poor, just like Nigeria is. Nigeria has tons of assets. We have oil fields, we have gold in Kebbi, we have palm oil in Abia, we have cocoa in Oyo, but we are cash poor. We are borrowing 1 trillion a month in Nigeria, but we have billions of barrels of crude oil. So in Nigeria's case, Nigeria has got a huge interest-bearing liability. 2 years ago, Nigeria was paying nearly 90% of her income to service her debt. 90% nearly. Today it's down to about 44%. So the income on the income statement Nigeria is making, we are paying almost 44% here to service our debt balance sheet. So the question is now, is the assets Nigeria generating, with this debt, what's the asset? The railways, the roads, that's the assets. The education people, we are the assets of Nigeria. So are the assets that Nigeria is generating out, is it being funded from this? Can we pay taxes? This is why the tax reform is passed. Can the assets of Nigeria pay taxes to cover the liabilities of Nigeria? So it's the same principle everywhere. Don't confuse income and assets. The point is, on the balance sheet side, we're worried about the net worth. What are you worth? But on the income side, we're asking you, that assets and that liability you have generated, what are they bringing in? Because you need cash to eat. You can't retire with assets. You retire with income, passive income. When you go to the hospital, you tell the doctor, I like to pay my bill. You don't tell him, I have a house down the road. You say, I have a credit card or I have cash. Write your check to pay for my health. So you retire with income. The business can generate income. If you have a business not generating income, that's a problem. Hope that clears that up. That's a good question. I hope that clears that up. Yes. Don't mix two of them. It's still an asset, but it's an asset generating income. That's our question, right? And the income goes to the income statement. Fantastic. All right, fine, guys. I do just a quick check. No other questions here. I love that. That's a good way for us to summarize. Let's start to wind down the space. So, guys, we talked this week around assets and liabilities. Last week we talked about income and expenses. So, what we're going to do now is that we're now going to sort of set the stage up for next week. Next week, we're going to talk around asset management. What we're going to do next week, we're going to say, okay, we want to invest. We've seen that we have to make passive income. We've seen that we have to grow our asset side to pay off our liability side. What sort of investment should we make to generate passive income? What should we invest in? That's what we're going to talk around next week. How can we have an investment plan? Where should we invest? How long? How should we do it? How should we select investments? That's going to be a great topic for us to do next week. So again, we'll be here next week. We'll be in a good internet situation so we can share all our pages and you guys can follow. You've been wonderful and I do appreciate you guys. Last point, guys, please do get the book. It's a fantastic book. I wrote it, got tons of experience in this field. I really want to just pass that information across to you guys, like I said. And that book will really help you because all these topics are all there. We'll just do page 12 and we can talk around page 12. We're also recording an audio version. I would say before the end of the year, we should have the audio version out just in time for Christmas. So you guys can give that as a Christmas gift, share it to your friends. It's going to be way cheaper. And you can also listen to the book and also learn. All right, folks, on that note, my name is Kalu Aja. Thanks for joining with me, spending your Sunday with me. Let's just end with just in a prayer for the country of Nigeria. It's our country. If you're not a Nigerian, we know we have an affinity to the country. We just want peace, we want safety for all those that have been taken from their parents. We just pray that the Lord will bring them back to their families in one piece. We know we can't return the emotional state these kids are on, but physically, if we can just get them back to their parents, that would be a big boost, not just for the nation. We've got to pray for the nation. There are lots of bad actors going around. We're just going to make sure that the nation stays strong, united, and of course, solid. So on that note, guys, let me let you guys go. You guys have a fantastic rest of your Sunday, and I'll see you guys next week. Thank you so